This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you. I'm at the Nedgroup Investments International Summit in London at the London Stock Exchange, and I've stolen away Ian Beattie from NS Partners, manager of our Global Emerging Markets Fund. Thanks for joining us, Ian.
Thank you.
Now, let's talk briefly about your prospects for the emerging markets over the next 36 months, say, and what are the things you're looking at to take some decisions or make some changes to your portfolio?
We were relatively defensively positioned even before the virus hit, because we thought that the policy easing in China was insufficient given some of their banking problems during last year, because we thought the money numbers were not accelerating enough for the economic recovery in emerging markets in general and in the rest of the world as well to be as strong as perhaps the markets were expecting. But going forward, although obviously our hearts go out to those affected by the virus, it could be a catalyst for further China policy response, which might be exactly what's needed. So there'll be economic disruption from the virus and the clampdown associated with it now, as the authorities admittedly rather belatedly act forcefully. And we could see policy action, meaning that we'll get an acceleration in money supply, perhaps in March or April time, which would then lead to economic recovery later in 2020, which will probably last through to 2021. So I don't want to preempt that. I want to wait until we see it. But you could see the pieces fall into place for a stronger recovery, but later rather than right now.
And you asked earlier today, you were asked an interesting question about which sectors might be positively or negatively affected by the virus.
Yeah, so basically if they involve a lot of people, they're going to be negatively affected. So leisure, restaurants, the casinos, all of these will be significantly affected and probably closed for a long period of time. Factories that are employing large numbers of people that have gone back home for Chinese New Year may be unable to reopen, or certainly not able to reach the levels of production people were expecting. So there'll be lost production there. The market will probably be quite good at looking through that, I think, as long as they can see when production will recover. But obviously it needs to adjust the economic impact for that. So some of these factories in China involve huge amounts of migrant labour, and obviously they're all away at Chinese New Year, which was a good recipe for spreading the virus, but also means that you can't necessarily reopen now. Now Chinese New Year is over. Okay,
and you recently reduced your Chinese exposure, but that wasn't on the back of this, was it?
No, principally it was as we saw the money numbers just disappoint. They weren't quite strong enough. They were okay, but they weren't good enough, and we thought the market was getting a little bit too excited. So we were getting defensive. Maybe we got a bit lucky selling the casinos before the virus really hit, and a few other. But we obviously did continue to get defensive once the virus did hit. But it's not the sort of crisis that we want to be selling some of our favourite names. If we think, that those we're looking for buying opportunities there rather than opportunities to sell.
So how did you reduce your exposure? What?
Just got more defensive, got the higher quality names, those that we think will get fewer downgrades. And those stocks, some of them have done very, very well. We took some profit in a few names. The big winner for us, like Li Ning, in the sportswear area, we were sitting on big profits there, so we sold that one, and a few other similar names as well.
And what about with the amount of people that are staying indoors more? What else? What effect would that have?
So computer games obviously might see some increased use, and e-commerce. People not wanting to go to the shops and want their goods delivered to them. So it's quite remarkable seeing how this already very strong sector has got a further boost from this. Of course, there are shortages. Some of the goods are not getting through, and somebody still has to deliver it. Which is obviously not a fun job at the moment. But it's remarkable how quickly people adapt. So I've already seen somebody ordering food delivered, and on the food, the bag of food with your meal in it, there is a note with the temperature of the chef, the server, and the delivery rider. So their body temperature's on there, so none of them are infected, which is quite remarkable how quickly the market's got the hang of that and adapted.
And when you say e-commerce, you talk about JD.com, Baidu, Alibaba.
That's correct, yeah.
But you still see the benefit of those companies into the long run.
Yeah, e-commerce has obviously been a big winner over the last couple of years. I think those that are winning will continue to do well. There are some new names that are very interesting as well. But we're actually also positioning ready not just for e-commerce and hardware. I think hardware's got further legs, so there's been a de-Americanization of the supply chain. Companies like Huawei have shifted their supply chain away from American firms to Asian ones, and we've had some big wins there already, and I think that's probably got further to go, the likes of MediaTek and so on, doing something that previously only American firms could probably supply Huawei with. So some of those themes have got legs. They'll do better. There may be some disruption to production, but I think that story will continue. But as well as e-commerce, I think we're looking to, after vision, which has been a big theme for a few years, we're looking at sound and AI to do with speech, which I think will create more demand for processing power and speed, and therefore the semiconductors and chips. So there's some specific investment ideas on that, but it will also mean the big winners such as Alibaba and the US big giants and TSMC will probably continue to do very well.
Okay, let's move away from China slightly, and a couple of other interesting countries that you do hold in the portfolio. One of those is Malaysia, and some interesting holdings there. Yes,
so our holding in the brewing company in Malaysia has done very well. Very steady performer. Don't get many downgrades on that company ever. It just seems to be continuously modest upgrades. It's a very profitable company. It is a duopoly. Both the companies there do very, very well. It's been a really good, steady performer. You don't normally look at it and find it's had a big move on any particular day, but you look back and you realise that it's just, delivered consistently. I went to see the company a few months ago. Very, very good operator, very efficient, and getting the innovations from head office as well, because it's part of a multinational. So it does very well indeed. Yeah, very strong. Southeast Asia in general, probably more liquidity sensitive, and don't want to overemphasize Malaysia, but the Southeast Asian countries in general, very liquidity sensitive. So if we're looking at weak economic growth globally, or maybe I should say sluggish, and policy response as a result from central bankers, Southeast Asia and those liquidity sensitive countries might be the place to be. They might be better than the big cyclical areas in the market.
Okay, I see. And when you mentioned earlier if the money numbers look better, can you just clarify what you mean by that?
Yeah, sorry. So we look at monetary aggregates to get a lead steer on the economy. But also we believe that if money supply numbers that make up those monetary aggregates is growing quickly relative to the demand for money in a country, then you have excess liquidity left over, and that can fuel markets. So that's why the market can sometimes behave in a different way to the economy.
Right, and liquidity, you just mean cash, right? Cash cycling around the system.
Near cash. It's the fuel for financial markets. We often say that money itself moves markets, and that markets need cash to operate, and they need confidence. So you need the risk premium to be moving in your favour, and you need a story to invest in. But that's no good if you don't have the liquidity, the cash to actually invest in those shares. So it's very important that the economy, as well as the markets, have that liquidity, that cash, that money supply.
And I noticed recently you've gone back into Turkey, and is that an example of a country that didn't have great fundamentals?
Yes.
And that kept you away, because it doesn't matter if you own the best company in Turkey, it wasn't an attractive investment.
That's right. We've been negative on Turkey for many years now, for structural reasons, as well as you say, you could actually see the liquidity conditions deteriorating in the economy, turning down and being a disaster for a good few years. We're starting to see signs that that's stabilising, starting to see money growth accelerate again. This is still tentative, but we're beginning to take an interest again, beginning to dip our toes in there, just for the first time in quite some time.
And are there any sectors that you think are more attractive than others at the moment, either through better valuations or just sectors that have better prospects?
Well, timing is crucial here. So given what we're saying about the economy globally being rather sluggish, we don't want to be too cyclically exposed. We want to be in other types of companies, either more defensive or quality, where they're going to get nice, strong returns on capital. So that's the overall picture. Then after that, it depends on which country you're in, because country is more important than sector in emerging markets. Like you said, no point having the best stock in Turkey or the best sector if it's been a very bad place. It was no good having Argentina last year, for instance. But there are certain patterns where different countries are going through the development ladder at different stages. So basically, how wealthy is a country? China, the action has been in consumer names and internet, because that's matches where the country is in development and where the technological changes are. So we've been in the sportswear names, we've been in e-commerce and so on. That's where the consumer is rapidly growing, the middle class is rapidly emerging. So those names obviously have a growing market. Somewhere like India, the income per head is much lower. So it's a generalization, but you'd expect to see consumer discretionary in China and perhaps more consumer staples in countries that are poorer, such as India or even Indonesia. It's not quite as simple as that, but you probably get my gist there.
Yeah. And then, so last question is, what's the external view on South Africa? And I know you hold a couple of companies there. Would you touch on which ones and why?
Yeah, I'm afraid we're still and we're not getting any more positive on South Africa. So it's not a bad place to hide sometimes when the rest of the world can look difficult. We have still, relatively high institutional quality and some good institutions in South Africa, and it's never quite as bad as perhaps some South Africans like to think. However, recent data are deteriorating, so we're significantly underweight South Africa, and it's probably headed lower.
Okay, and which companies do you hold there?
A couple of banks and
right. Nedbank?
No.
Oh dear.
Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.